Look, we're debating with Mohammed El-Arian in an opinion piece. He said, don't quickly expect a rebound. There are potential for cascading spillovers in trade, supply, and demand. What is the biggest possible cascading risk from coronavirus, in your opinion?
I think it's the supply chain. It's obviously going to affect it severely in the short run, but then you have to assume that businesses that were affected are going to need to look to change the dynamics of their supply chain. If they're too heavily dependent on China, be more diversified, and this could just slow business investment.
In 2008, we worried about counterparty risk. What is the biggest risk right now in markets for you? We're backstopped all the way. So what's the counter side to that trade? What is the biggest risk?
I think the biggest risk is really just if the consumer becomes less confident. It's been driving the U.S. economy, which has led the global growth in many respects. If consumers all of a sudden become less confident, especially if they start losing jobs, that could create a slowdown which would just drag the economy into a recession.
But we're pretty far away from that at the moment, though. It's a strong economy.
It's a strong economy on a relative basis.
Okay.
But you give enough shocks and then you could see a slowdown 12, 18 months from now if we don't see something to the positive on the other side.
MLive blog this morning says that US exceptionalism was supposed to fade this year. EM was supposed to pick up the trophy.
Right.
Does US exceptionalism continue in 2020?
We're of the mind, Barings is of the mind that we expect the U.S. economy to continue to grow at trend for the rest of this year. We don't think that it will slow materially, barring shocks, but if it does, that could change the nature of that. Will that mean that the emerging markets take over? I think it depends on the issues coming out of China in particular, whether that has a knock-on effect for the rest of emerging markets.
The core of the business at heart is fixed income in many ways. So I want to get your take on credit. What are clients doing in the credit markets at the moment? Where are they reaching for yield, and are they buying these dips as everybody's telling me?
Well, clearly in the extended low rate environment, high yield has become more in favor with a lot of investors who did not allocate there 10 years ago. We are very constructive on the U.S. markets. You have to watch certain industries, like the pharmaceutical industry, the retail industry, but we're still constructive if you're able to select good fundamental value in the high yield markets in the U.S. and Europe.
Do you think the Fed, we've got the semi-annual testimony coming up, and people are saying Powell's going to have to find his inner dove to backstop the markets. Do you think he's going to find his inner dove? What does that mean to you?
I'm not sure what an inner dove means, to be honest.
I think it probably means rate cuts, a lean to rate cuts.
But I think the Fed is clearly data dependent in a lot of its decisions. I think they're in our view at Barings is they're in a holding pattern for now, and until you see something to move them, to tighten or move them to ease more, I think they're going to hold steady for the time being.
I caught up with Anthony Scaramucci from Skybridge just there having a cup of coffee. He said to me he's still very defensive, and his phrase was he thinks the markets have the Fed in a Gordian knot. I said, well, what do you mean by that? He said, well, eventually they're going to have to let the markets off the leash. Would you agree with that? They have been the royal backstop for 10 years, haven't they? What's the consequence of a Fed not responding to every moment of panic in markets?
Well, I think the consequence is if you respond to everything, then you have no conviction. You have no conviction as to which way you're driving monetary policy. So I don't think the Fed responds to everything, but they certainly are mindful of the markets when they trend in a negative or positive direction. I still think they go back to the data on the economy, on the consumer, on unemployment in the end.
At any juncture, we're writing stories today about deficits and debt in the United States of America. And again, the deficit's rising, debt to GDP is rising. At some juncture, do markets, have we been ignorant of those two major Ds?
I don't think the market is necessarily focused on the level of the debt and pricing in. At least from a stock market standpoint, I think it's more short-term views and moves more in line with unforeseen situations like we've had with coronavirus. I think what's different than a decade plus ago is at least when the market is absorbing bad news and it widens out or drops, spreads widen out, there is capital that's there to invest when those markets drop. They're not in a free fall like they were during the leverage unwind in 2008.